CWG Computer Warehouse Group, one of the companies listed on the floor of the NGX, doing amazing numbers if you ask me, because hey, these guys are big on IT services as regards when you're talking about cloud services, you're talking about IT infrastructure and even software. They are big on that. And it looks like a lot of investors are interested in companies in this industry because, you know, we're literally in a global village. These guys are on the front burner of conversations when we're talking about IT infrastructure. But let's talk about their numbers. Let's talk about how well they're doing. And this is the show for you in good company, where we give you up-to-date research and conversations around different companies listed on the floor of the NGX and even some investment opportunities. And joining me for this conversation is no other person but a city gentleman, Idika Aja, who is a financial analyst. You're very much welcome to In Good Company.
Yeah, thank you. Thank you, Frank.
Yeah, decent numbers if you ask me from CWG. What is really behind this rally?
Okay, for 2024 financial year, I think they did very well based on the release results.
Yeah.
I think they grew their revenue by 92% to about 46 billion. Now, driven by, I think you have three major subunits, that's SBUs. The IT infrastructure, the
cloud
software, what they call software, and the managed services. So I think where they recorded the highest chunk is the software, which generated about 16 billion. They're giving them about 36% of their total revenue.
Very true.
So they did very well there. And based on that, they grew their gross profit to about 9 billion. Then profit before tax of about 4 billion, and net income was about 3 billion. So they did very well, driven by these three key subunits.
Very true.
And with the growth in IT, especially because their major customers, MTN, UBA, and First Bank. As a matter of fact, they generated about 19 billion from MTN, which is very massive for them. So they did very well.
Yeah. They can't afford to lose that client.
Yes.
Yeah. So let's move on to the next question. Do you see any risks as regards their performance? Looking at their financial performance in 2024, do you see any risk attached to it?
Yes. I think where they have, it's not a red flag, it's still it's a risk, and which I believe they are, because that is their management of working capital. CWG, they have a credit policy of 90 days. And give and take, if you look at their, what we call, there's a receivable outstanding and there's a payable outstanding. When you look at their receivables and the payable, I think that's where they have a challenge. Even though they generated an impressive cash flow from the operating activities, about 5.8 billion. But yet they are carrying a lot of receivables and the payable. That means that the profit they are declaring on paper, yes, okay, but it's more or less like they are selling on credit. That's
very true.
For the layman, that they are selling on credit. And the concern too is where their receivables, their receivable outstanding is more than their credit policy of 90 days. At least if you calculate, they are having about, I think, about 132 days for them to collect back their money, the one they have sold. And but in essence,
days.
More than the 90 days.
Yeah, more than that's what I was going to say. More than the 90 days.
But if you look at it the other side too, they are equally working smartly. When you look at the what we call the days payable outstanding, which is about 150, I think 150. 53 days. So you can see now they are using other people's funds to manage their working capital.
Very true.
So it's taking
the
them
operations.
Yes, they are, when they collect, it takes them about 153 days to pay back. But when they now sell, it takes them about at least an average of 132 days to pay. So they have a gap of 21 days. So they are working smartly, but it is not the best. You understand? Because if they don't address it, if they don't collect their money in good time, it might affect their cash flow, and they might look for ways of trying to finance their working capital, and that will lead them to maybe looking for money to fund their working capital.
But they won't be the first to be looking for money.
I think that's the only area I see they have a challenge in 2024, and though they are working smartly by allowing the days payable outstanding to be higher than the days receivable outstanding.
Okay.
But the main point is that the days left for them to collect their standing is higher than their credit policy of 90 days.
So it's the season of dividend, and it looks like in 2023 they paid 16 kobo per unit share, and they are looking at increasing that to 39 kobo in 2024. They increased that to 39 kobo in 2024. What does this mean for a lot of investors?
Yeah. They paid 19 kobo in 2023 and increased it to 39 kobo. That's about
I think it's 16 kobo. 16 kobo.
In 2023. Then 39 kobo.
39 in 2024.
I'll give you a growth of about 144%. That is okay. But if you look at the payout ratio, at $16 naira in 2024 gives you a payout ratio about 70%. That means they paid about 70% of their earnings in 2023. But now, looking at 39 kobo and looking at their net income, that brings about 32% payout ratio. You see that the payout ratio dropped. So what literally means that they are not too aggressive in returning to shareholders. Maybe they are withholding some for expansion, which is equally good. But
very true.
For a growth,
they need a lot of working capital. You just said it.
For a growth-oriented, for an income-oriented investor, that might be okay for him. But for a growth-oriented investor, at least expansion is okay, and that is okay. Even though they have increased their dividend, but in terms of payout ratio, it dropped to 32%.
So let's do some comparison here, a bit of comparison. Look at their share price performance in comparison to their financial results. What do you think about that?
Well, I think the share price as at yesterday closed, I think about 8 naira, and that is about gives you about 9.09 year-to-date gain.
Oh yeah, that's right.
So, well, if you look at it and look at the growth in their earnings and revenue, you might think that okay, these maybe these things have not been really priced in. So, but I think either maybe people are still waiting or still cautious. But I think with the results released and looking at the numbers, definitely it will affect the share price going forward.
So their PE ratio is around 6.9x. What's your take about that? Do you think that will be quite appealing to a lot of investors? If you look at their numbers from the BP as well, how appealing do you think that will be to a lot of investors at this point in time?
Yes, it's okay, but you have to take other ratios too.
Yeah.
They have a PE ratio of 6.94. They have a price to book ratio of 3.2, and they have a price to sell ratio of 0.46. Now, if you look at the price to sell ratio of 0.56, which is at a discount, because it's saying that for every 1 naira in revenue, the investors are paying 46 kobo.
Yeah.
Which is okay, which appears relatively undervalued relative to revenue.
Meaning it can even easily go 2x.
Yeah, if you look at the price to earning ratio at 6.94, that is relatively priced very well.
Yeah.
But I think the headwinds on the valuation is the price to book ratio, which is about 3.2. It's telling you that that you are paying higher, or maybe investors are expecting growth.
Okay.
So that's why they are paying for every book value, for 1 naira book value, you are paying about 320 kobo.
Buy, sell, hold, CWG. What side of the
CWG,
camp would you be?
CWG is a dividend paying stock.
Yeah.
I always like dividend paying stocks, because at least.
But 39 kobo is that you just said recently that might not be too.
No, I'm not saying, I'm not talking of the absolute value.
Yeah.
I'm talking of the payout ratio,
yeah, that's right.
Which is good. At least they are returning up to 67% of the earnings probably for expansion or something like that, or for other things. The dividend yield should be about, I think, 4.6. So which is, though not much, but at least it's something.
Very true.
To me, it's okay. I always like dividend paying stock. And now you have they are mixing it together,
very
growth
true.
and income. For me, it's a buy for me, but the only aspect we always tell people is not only, even when a stock is doing, you have to find out the liquidity, the volume, the trading volume, so that even not when you buy low and when you want to go out, when you want to sell, it becomes a problem. And I think that is the only challenge in terms of trading volume.
Okay.
So in terms of trading volume, I think they are number 50, I think 52nd most active stock for the past 3 months.
Yeah.
And I'm not too sure whether the volume today is about either 130 million or thereabout. But another thing we have to check that can determine whether it is a good stock to buy is equally their free floats. And I understand that the recent road to NGX to give them time to increase their free float.
Okay.
You know, when you don't meet the free float requirements of 20% as directed by NGX,
Very true.
it becomes a problem. That means your shares are tightly held, and any fluctuation, if the shareholder decide to buy, it can automatically influence the price.
Very true.
Basically, what is important is the trading volume, so that, and the liquidity, so that you can move in, can come in and go out. And looking at the beta, the stock beta, which is about 0.4, that is 0.4.
Yeah.
That means it's not moving in line with the market. So that means actually it could be the fundamental that is driving the growth or driving the stock movement, not really because of market sentiment or what is the overall, the broad market situation because of the stock beta. So for me, it is okay. For now, it's a mixture of where do I go? Where do I go? Where do I go? Where do I go? For me, for a system, I will hold.
You hold?
Yes, I will hold and watch.
Okay, you've heard from Idikaja, and there's something I've really noticed about people who are elderly investors. I like to put it that way. Many of them tilt towards dividend-paying stocks, but you see younger ones who have high risk appetite, they tilt towards growth stocks because, hey, you've got a lot of time if you're young for you to be able to catch up with the growth of company, especially one that you see who is pitching their tent on the tech side of an industry. I think that the sky is really green for them because, hey, look at their numbers, decent numbers if you ask me. And that is it on this episode of In Good Company. My name is Frank Fagbo, and always remember that this was brought to you by Metrics Television. I'll see you on the next episode. Make sure you like, share, subscribe. Cheers.